it won't apply to most employees because, of course, they're taxed under pay as you earn, or pensioners, unless they have other income, really, of more than £10,000 per annum. We're told that the way this will work is that HMRC will pre-populate our tax accounts with the information they already hold about our businesses or us as individuals. That effectively what it's aiming to achieve is that we'll get our tax bills in real time. And it has been said that we'll be reporting on this at least quarterly. So instead of having to do your tax return just once a year, 9 months after the year end for individuals, or filing a year after the year end for companies, it sounds as though you'll actually be required to do it more or less in real time, or at least on a quarterly basis. And they've said that also there'll be the ability to pay as you go, really, with your tax. And so I think this raises the first question that I wanted to have answered, which is to ask, really, with the move to digital accounts, do you expect to be paying tax sooner? I think my view is that we will see the revenue moving to asking people to pay their tax earlier. And just looking at the results that are coming up on the screen, I think it very much looks like all of you out there agree with me, and actually the vast majority of people are saying tax is likely to be paid sooner with the introduction of these digital accounts. I suppose there's a question about whether HMRC can deliver on it, and I think it's fair to say that some are more than sceptical about that. And I was just doing some research on the internet, and I came across something by James Moore of The Independent saying HMRC a digital tax titan, ? It can't even answer the phone. So clearly James is very sceptical about the revenue's ability to deliver this. I think perhaps he misses the point that HMRC don't really want to speak to its taxpayers, and actually this is a move to robotise tax compliance even further. I'm now going to hand over to John, who's going to start talking about some employment tax issues.
Okay, so I think the first surprise announcement that was actually made during the speech last week was a bit of a kick in the teeth for company car owners, because the 3% diesel supplement that applies to diesel cars, and a large part of fleets normally are diesel for economy reasons, was due to end on the 5th of April next year, and has now been extended right the way up to 2021. Alongside that diesel supplement, previously announced increases in the benefit in kind rates have been confirmed to be 2% per year, right the way up until 2019-20, when the increase will actually be 3%. We're assuming at this point that the top rate of benefit in kind will still remain at 37%, but this hasn't yet been confirmed. If we have a look at what this will actually mean for a typical company car owner, this is BMW's typical fleet car. It's the Efficient Dynamics 3 Series. It has a list price of just over £30,000 and quite low emissions. If we look at how this is going to affect the tax paid on that particular vehicle from now until 2019-20, each year the benefit in kind is going to steadily increase, and at the end of the 4-year period, the individual will be paying has a 50% increase in the amount of tax they're paying on that vehicle. For those that actually thought they were planning ahead and were anticipating the 3% supplement, these are the figures that they were expecting, and you can see that across the board that the tax rates are significantly higher than they were anticipating. The way that company cars are taxed at the moment still throws up a few anomalies. I believe we've posted these slides before, but just as a reminder, this is a company car which we have seen some of our clients taking out alongside the Tesla, which is an equally expensive hybrid vehicle or electric vehicle. It's currently taxed at 5%, which leads to a company car rate, a low company car rate. The Ford Mondeo, another typical company car, very low list price. But if we look at the surprising difference between the benefits in kind that will be payable on those two vehicles, as things currently stand, the hybrid BMW is far cheaper than the Mondeo. It's worth noting that as the 2% rates kick in over the next few years, the BMW would become much more expensive than the Ford, but right now that's as it stands. We now move over to another employment issue that was confirmed at this autumn statement. They previously announced there would be an apprenticeship levy for large companies. The rates have now been set at 0.5%, but employers will receive an allowance of £15,000 a year. If we look at what that actually means, if the salary cost of a company was 4 million, the apprenticeship levy would be 20,000, less the allowance, so then net levy would be £5,000. The effect of the allowance is to take out of this charge any company with salary costs of less than 3 million. But that's not to say that this will be removing the apprenticeship levy. The policy is set to raise £3 billion by 2021. So there will be a significant charge to many employers. Okay. Part of this levy is to pay for the break that comes in from April next year for apprentices under 25. This was previously announced, but this is how they're going to pay for it. There's absolutely no NRC for apprentices who are working in a government-approved apprenticeship scheme. Good break for employers. Another NRC break that's been around for a while, which was the £2,000 NRC break for all employers, has been extended to £3,000. This removes the NRC burden for very small employers. Auto-enrolment is the pension that everyone should know about. Everyone now has to be auto-enrolled. There were due to be increases to the rates at which pension contributions were made. They were due to come in October 17 and October 18. These have both been delayed for 6 months to align them with the tax year, which is a very sensible move. One thing we should point out here is that the last staging dates for auto-enrolment is next April. There are an awful lot of small employers that are going to be coming on board with auto-enrolment and not many suppliers. So anybody who is yet to stage should make the move to get things sorted out as soon as possible. When RTI came in, and this is the reporting of payroll taxes as and when you pay people, there was a large move from small employers, particularly those that were paying people on a daily or a weekly basis, to say that the RTI reporting was onerous. HMRC and the government allowed there to be a relaxation of the rules so that those people could report weekly or monthly. This relaxation is due to end in 2016, which will bring those employers in line with everybody else. And the other big change in the way that employers are going to be complying with revenue regulations is the removal of P11D reporting dispensations. They are coming out at the end of April 16 because they will be replaced by some form of legislation to exempt business expenses. I'll hand you back to Alex now, who will discuss some other matters.
Okay, the next topic I'm going to talk about then is the new tax regime for dividends. Really that first slide there is just comparing the current effective rates of tax on dividends with the new regime, which will apply from the 6th of April 2016. If the effective current rates look a little bit odd, it's because we currently have a notional tax that attaches to our dividends, and that sort of impacts on the overall tax rate. These are the actual effective rates of tax that a basic rate, higher rate, and additional rate taxpayer will pay on the cash dividend that they receive. So quite a big increase, 7.5% across the board, clearly aimed at collecting more tax on dividends, but in particular from owner-managed companies. And it's expected that this will raise around about £2 billion a year for the government. The one further sort of change, aside from just the 7.5% increase, is also the introduction of the so-called dividend allowance, which will mean that you can have £5,000 worth of dividend income every year, and that's across the board. Every taxpayer can have that, to which no tax is paid. So what does that mean in practice then, really, for those who draw money from their company as dividend rather than as a salary or a bonus. So this slide here just compares two scenarios. The first is profits of 60,000 available, and the second is profits of 100,000. And we have here the tax that would apply for 2016-17 tax year if the current basis of taxation continued to apply, and then comparing that with the changes that have been announced. So for our company that has £60,000 worth of profits, then if the owner of that business were to take that as a small salary, which is normally the most tax efficient way to do things, and the rest as dividends, they're going to see a tax increase of approximately £2,000 per year. So not an inconsequential amount. And as you'd expect, when you increase that to look at the £100,000 profits, the increase in tax actually comes up to over £4,000, £4,345 there on the example. So again, it's a big tax hike. I think it's worth just commenting that for owner managers of companies, it's still going to be worth taking that basic salary and dividend rather than drawing all your earnings effectively as salary or bonus. There's still a worthwhile tax saving to be had by following that route. And that looks to be broadly the case at whatever rate of tax you might pay. This leads me to my next question. I'd be grateful if you could answer for me, please, which is to ask, so we've said that from the 6th of April 2016, tax rates on dividends will increase. And the question is, over the life of this Parliament, do you expect tax on dividends to A, increase, B, decrease, or stay the same? There has been quite a lot of talk about the triple tax lock that this government have introduced, whereby they've undertaken not to raise the headline rates of income tax, VAT, or NIC. So that basically means the Chancellor's got to look to raise tax elsewhere. And there is a feeling that this is just the first of an increase on tax and dividends that we'll see going forward. So the answer that we seem to have on there is, well, it's roughly split actually. Over the life of this Parliament, approximately 50% of you think that the Chancellor will go further and raise tax on dividends even more, and the other half of you think it's likely to stay the same. So just some thoughts really on actions that people might wish to consider in advance of this change or alongside this change. I mean, clearly it's going to be important to make sure that you do actually use that dividend allowance each year. £5,000 worth of tax-free income, it's worth having. There are still legitimate opportunities to split income between spouses and civil partners, and those are worth exploring always. But it does come with a note of caution. We do quite regularly see arrangements that are very prone to attack. For example, where there's a spouse who's not involved in the business and they're given a very thin class of share that has no voting or capital rights, and they're just receiving dividends. We wouldn't recommend that as a course of action, but if you're giving non-working spouses shares that carry full rights to voting and capital, that's a more robust arrangement, but there's more to it that needs to be considered. Some of our clients are actually considering accelerating dividends into the current tax year. Obviously, this has the disadvantage that you're accelerating when you don't have to pay tax on that dividend. But if that's allowing you to lock into the pre-changed lower rates, then that can be advantageous. Of course, this is subject to having sufficient distributable reserves, accumulated profits within the business. And obviously there's obvious pitfalls to watch out for there, that by accelerating you don't actually take yourself into a higher rate of tax anyway, because you say move from a higher rate taxpayer to an additional rate taxpayer, or perhaps because your total earnings will be over 100,000 for that year, and then you'll start to lose your personal allowance. Tax efficient profit extraction through pension contributions is still worth considering, and indeed for some actually deferring dividends might be the answer. And that's particularly likely to be the case if you're contemplating a sale of your company, and you can perhaps take it out at 10% with a CGT rate effectively, and the benefits of entrepreneurs relief. In a nutshell, really take advice, and because there are pitfalls to be avoided. So finally then on tax on dividends, just to mention also about whether to incorporate or not. Over recent, well, for many years now, there's been an awful lot of businesses incorporating and it's been tax motivated. It's been to achieve a tax benefit. Our calculations show that if your business has profits of up to around about 140,000, then there will still be a benefit in most cases to operating through a limited company rather than as a sole trader. But actually, when you factor in the additional compliance costs that are associated with running a limited company, that benefit is significantly eroded and probably to the stage where, in actual fact, it's now really commercial factors which will decide whether or not it's right to incorporate a business. A brief word about capital allowances. As most people will probably be aware, capital allowances are effectively the tax form of depreciation. Depreciation that's charged in a business's accounts is not allowable generally for tax purposes, and relief for plant and machinery acquisitions is given through a system of capital allowances. Sitting alongside that, all businesses have an annual investment allowance, which is the amount that they're allowed to write off on most plant and machinery acquisitions in the year of acquisition. So currently a business can spend up to £500,000 per annum and write that off in full for tax purposes. Well, that rate is dropping to £200,000 from the 1st of January 2016. That was confirmed at the summer budget. But the point I really want to make is about how the timing of capital expenditure can be critical for accounting periods which straddle this rate change, the 1st of January 2016. So if here we have an example where we've got a company with a March 2016 year end, the annual investment allowance for that period, for that full year, is £425,000, which is effectively 9/12 times the £500,000 rate, and 3/12 times the £200,000 rate, 425,000 in total. But actually, if you're incurring capital expenditure in the period from the 1st of March to the 31st of March, you're actually capped at 50,000 of annual investment allowance for that period. So if businesses are contemplating further capital expenditure, this particular business, if they were contemplating, say, a significant amount of capital expend exceeding 50,000, then they might want to try and accelerate some of that and get it before the 31st of December 2015 rather than afterwards. My final topic today then is research and development tax credits. It's something which I talk about on a regular basis, and if you've heard me speak about it before, then I make no apology really for including it again. There have been some recent changes, and actually it's an extremely valuable source of funding for companies, and it is a relief that's only available to companies. And it's still overlooked by quite a surprising number of businesses. So how's it valuable? Well, effectively there's two schemes that we have here. So the first is a scheme for small and medium-sized enterprises, whereby basically they now can qualify for a 230% super deduction for their eligible costs. What does that mean in terms of tax relief? If you've got £100,000 worth of eligible R&D expenditure, that effectively equates to £46,000 worth of tax relief on your £100,000 spend. But it goes further than that for SMEs, because actually if they're loss-making, if they have R&D losses and the super deduction enhances those losses, then they can choose to surrender those for a payable tax credit. That's cash back from the government, and that's paid at a rate of 14.5%. So again, taking our £100,000 eligible spend example, they could actually claim back from the government a payment of nearly £33,500. So it really is quite generous. And £100,000 worth of eligible R&D spend is very modest for most of the claims that we submit. Perhaps also worth mentioning that there's a scheme that's available to large companies called the RDEC scheme. It's less generous than the SME scheme, and effectively it gives tax relief at a rate of 11%. But actually, for loss-making companies, it can also be surrendered for a payable credit now, and that's currently paid at a rate of 8.8% of the eligible expenditure. And I put on the slide there that it's also applicable to many SMEs. And the reason for that is because a lot of SMEs will be wholly or partially barred from claiming tax relief under the SME scheme if their R&D has been subsidised or grant funded, but they can still claim that or still make a claim under the large company scheme. So what we're increasingly seeing is that a lot of our SME clients who have had grant funding are now making a partial claim under the SME scheme and effectively topping up under the RDEC scheme for larger companies. Just note that you do need to claim within 2 years of the end of your accounting period, otherwise your claim typically becomes time barred. So there is a hard deadline by which action is needed. So just a quick canter through really whether your company would be eligible to claim R&D tax reliefs. Well, I put on the slide probably, and I caveat that by saying probably for innovative companies that are looking to take new products to market. R&D has a specific definition for tax purposes, and basically projects must seek to achieve an advance in science or technology through the resolution of scientific or technological uncertainty. And it's that last word that's key there. The outcome of the R&D effort needs to be uncertain. If it is, it's quite likely you're undertaking eligible R&D. Certain activities are excluded, for example, social sciences and things, as stated on the slide. A final point on that particular thing is we are now seeing an increase in HMRC inquiries into software-based R&D claims. I think there was almost a perception that because it was software, it had to qualify as R&D. That isn't the case. Software-based R&D claims do need to be properly substantiated, just as anything else, and there is an increased area of focus here for the revenue. So finally then on R&D, just to mention about something which was introduced only last month. It had been previously announced, but it's now with us. And this is an advance assurance procedure for R&D claims. So what this basically means is you can go to the revenue, tell them what you're proposing to do, and if they agree that that's eligible R&D, they will pre-authorize you for 3 years. And they then undertake that they won't raise any inquiries into your R&D claims for at least a 3-year period. Obviously, there are going to be certain safeguards that are built into that process, but this is something that's with us now. It's a facility that's available, but it's only open to companies that are claiming R&D tax credits for the first time, and they must have a turnover of under 2 million and under 50 employees. The revenue is suggesting that it may help companies secure other sources of funding because they're able to prove their entitlement to R&D tax credits. Agents can handle the process, and it will involve an interview with the revenue, in most cases over the phone, and that will need to involve the research manager or the company director. Essentially, the revenue just want to be confident that you understand what is eligible R&D for tax purposes and what costs you're entitled to claim. If they're satisfied with that, this will be an extremely useful facility, I think, especially for early stage companies. And now back to John then, to cover off a few final points.
Hi, we're going to start off by looking at the further attack on buy-to-let landlords. I guess they are a fairly easy and soft target. They generally make money and no one's going to complain too much if rich people are taxed. So they are a soft target from a political point of view. There's already been pressure on those individuals following the budget because interest relief has been restricted. The pressure has now been piled on further. There is an additional 3% stamp duty cost on purchase of homes in excess of £40,000. This will also take the top rate of stamp duty for homes worth more than £1.5 million to 15%. The measure has been could lead to a shift in the residential rental sector away from individual buy-to-let landlords and into institutional investors. This is because corporate and fund investors do get interest relief, and this stamp duty charge is unlikely to apply to them, although it has been announced that the government will be consulting on the scope of the appropriateness of the exemptions for corporates, so that changes may be on the way to level the playing field. It also remains to be seen how second homes will be defined, particularly with regards to overseas buyers who will presumably have to self-assess that they already own a home elsewhere in the world. The other motion that's passed is that an acceleration of the tax due, CGT due on second homes has been accelerated to 30 days post completion of the sale. This is significantly in advance of where tax previously would have been paid, and also puts a lot of pressure on the individual to actually work out what the gain on that property might be. It's strongly advised that second homeowners pre-calculate their gain in anticipation of a sale once these measures come in. And the last two things we're going to talk about, salary sacrifice arrangements. The government have announced that the government is concerned that the growth of salary sacrifice arrangements and is considering if action is necessary. The concern, of course, is that employees and employers who utilise salary sacrifice arrangements reduce their NIC costs significantly. The government will gather further evidence, including evidence from employers on salary sacrifice arrangements, to inform their future approach on the matter. And lastly, the pension review. It's been going on for a while, and the Chancellor announced that he will release the outcome of the consultation at the budget in 2016. This currently costs the government somewhere between 30 and 50 billion pounds per year, and is obviously a tempting target for the Chancellor. So the respite for employers and employees is likely to come to an end. Okay, we've counted through most of the measures that we thought were pertinent, but if anyone has got any specific questions about the Autumn Statement, please let us know.
Okay.